Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari.
Hello.
In this episode, we're going to be talking about spinoffs. For those of you who don't know spinoffs, we will talk about kind of the details about spinoff, but at high level, this is a special situation where a lot of value investors actually focused on to make outsized returns. And we'll talk about a few names in this podcast that really focuses on spinoff situations. So before we do that though, Hari, should we do a quick disclaimer?
Yeah. So this podcast is designed for helping you learn how to think like a value investor, educate yourself. You should use it for educational and entertainment purposes only. We are not a financial advisor, nor do we know your specific financial situation. So if you do need to make investment decisions, we consult a financial advisor before doing so.
Perfect. All right, let's get this started. So Hari, as we do a lot of reading on spinoffs, or as we do a lot of reading on value investing generally speaking, spinoffs actually does come up quite a bit in special situation circumstances or an opportunity to make really outsized returns. Yeah. And there are a few people who talk about it, but namely there's Joel Greenblatt. He's the guy that really kind of talked about it in his book. But actually, before we go into that, let's do maybe a little bit of detail on give our listeners what is spinoff. Can we start with that?
Yeah. So typically businesses, are at a single operating entity, and over time they may either create their own business that's in a separate line, or they may acquire businesses as part of a strategy of acquiring new businesses, but they're all under one kind of umbrella. So there's a couple of ways that a business can realize the value of a child business, right? If we talk about it like a parental relationship, the parent company, has the business, has 2 or 3 or more operating businesses. It can sell the business to another company, or what it can do is actually, in a tax efficient manner, it can spin off the company. So if you own shares in the parent company, you will get a equivalent number of shares, and it may be in a special ratio. 5 shares for the parent, you get 1 share of the child, and it'll be spun off to the general public. So anybody who owns this stock in the parent company will also receive shares in the child company, and this is done for a lot of different reasons, and this is not an IPO, so there is no money that is raised as part of this process. So the owners of the parent will get ownership in these child stocks, and they'll just show up in your account. There's nothing you have to do. And typically there is no tax cost for that, because you're just splitting a business that you already own into multiple trading entities. So you will encounter a tax when you sell it, and that's something that is dependent on when you purchase the parent. But typically this is to kind of say that, the child is something that the owners of the main business may not even realize that the child is there or what it's contributing, and that they want to split these assets out, and that's kind of why spinoffs exist. So you may not know this, but in the 70s, Sears was actually the owner of a lot of many businesses that they either built out on their own or acquired. And what they did was they spun off a lot of those shares. So Allstate was actually one of the companies that was spun off from Sears. Ferrari was spun off from Fiat Chrysler. So there are quite a few businesses like this that are spun out, and it's usually to unlock shareholder value. That is the primary reason that people do this.
Yeah. So at a high level, this is really like you said, parent-child relationship where You have, when your business is growing, you have many, many different subsidiaries. And let's say if one subsidiary is doing particularly well or particularly not well, then you spin this off into a separate entity. That's one key point. The second key point is that the spin-off, the way that companies spin the subsidiary off is different than an IPO. You can IPO your subsidiary too, but you can also spin off your subsidiary. So it's a different way of spinning out this child entity, and it has tax advantages. So that's the third point that I want to point out. So those are kind of high level a perspective of what Spinoff is all about. Just to summarize what Hari pointed out there. So I think a good segue is, we talk about spinoffs, but ultimately, as investors, we want to make money off of this. And why is it important to focus on spinoffs? Is because many great investors really focus on spinoffs because of great returns that it has generated previously, historically. So if you could talk about maybe historical returns for investors who really focused on spin-off strategy. Sorry.
Yeah, if you, I think this was a published study in like 2015 that if you had bought spin-offs from 1980s till 2015, and you owned every single spin-off in equal amounts, you would have gotten a 20% annualized return. So, the S&P 500 gives you about a 10% return. The spin-off is double that. So, and that's owning every one of them. So not all of them are profitable spin-offs. Some of them turn out to be duds. Some do nothing. The idea here is that owning a spin-off is a good place to look for value, because the reason for the spin-off is to unlock value. So you're kind of looking in a target-rich environment, as it were, when you start looking into a spinoff. And in addition to that, there is other things that we'll talk about that would put you into a good situation. So I don't know if you're on YouTube, you can see us, but I'm holding "You Can Be a Stock Market Genius," which is a book by Joel Greenblatt, and he is a fantastic value investor. In many ways, he kind of pioneered some of the thinking around spinoffs, but it's not something that was his idea to begin with. This is something that he knew about and has been using to great advantage. So he runs this firm called Gotham Capital that from 1985 to 2006 rather. Was annualized returns of over 40%, which is the highest of any value investor that I'd heard of.
That's insane, by the way.
Yeah.
Let's pause for a second and really look at that number, Ari. Yeah. Annualized 40% for basically over 2 decades is insane return.
Right.
That's
Part of this is also he ran the company for 10 years with his own money. So he returned money to shareholders when he during the dot-com boom, he kind of gave the money back to the shareholders and said, I'll just take my own money. I've made plenty of my own money, so I will do that. And he talks about using these quote unquote special situations. So there are other special situations that he talks about in the books. Spinoffs is one of them. He also talks about post-bankruptcy companies, so companies who are in the bankruptcy process, but who have completed the bankruptcy process as being another good place to look. So maybe in the future we'll talk about these post-bankruptcy kind of things, but for now, spinoffs are kind of this a good place to look. Charlie Munger has mentioned them as a great place to go. The thing that you'll probably notice about it is a lot of these spinoffs are very small companies. They are part of a larger parent organization that may be in the S&P 500 or maybe part of a bigger index. And then, the child is a much smaller entity. So, these big institutional investors can't really play in the spinoff game because they just have too much money. And that is something that we can use to our advantage because we are able to invest in these places. So
yeah, we're not managing millions of dollars, hundreds of millions of dollars right now.
But at a solid rate of return like he was getting, that number will become hundreds of millions of dollars pretty fast.
Exactly.
So
Yeah.
I would encourage you to start thinking about this as a good place to look. That doesn't mean that you stop looking in other areas, but there are just like with anything, there are times where there are a lot of spinoffs that are coming up, and then there are times when there are very few. So it's not always a guarantee that you're going to see a lot of these. And not every one of them is going to be a winner. So
I think we didn't do enough justice on maybe downside of spinoffs, because it is a way for the parent to get rid of an ugly child.
Right.
So, for example, if you have a lot of debt, you can just pile your personal debt into a child company and then just spin that off so that the parent company has clean balance sheet. Companies use this method to clean their balance sheet. So not every spinoff is a great opportunity, but some spinoffs really present to us investors really good opportunity to partake in an upside of a company that's underappreciated had it been still with the company. So I just want to make that clear that spinoffs are not always good, but it can be good for investors.
Right. And I think that's a very important part. This is not a blindly buy every spinoff that comes through the door. It's like everything else. Doing your own homework will help you find a good place to look, and then it's up to you to really determine what is the best use of your capital allocation. So all of the things that we've learned, we're still valuing a business. We're still identifying what value there is to the company, and then trying to buy at a significant margin of safety.
Mm-hmm. Yeah, exactly. Yeah, again, to Hari's point, Joel Greenblatt didn't really invent this, but he is kind of really one of the famous heavyweight and value investors who has championed this spinoff strategy. And it's not to say that he's the only one who has benefited from really focusing on the spinoff strategy. There has been numerous studies that shows that if you really focus on the right spinoffs, you can get really outsized returns. And so all that to say, spinoff is a great fertile ground to look at good opportunities. And so I think this is a good transition point to think about, why is it such a good opportunity? We talk about unlocking the shareholder value, like you said, Hari. You talked about, spinning it off instead of an IPO that gives the parent company tax advantages, and also the shareholder tax advantages. But more fundamentally, why is, if you think about from an investor standpoint, why is this such an attractive place to look?
Yeah, so when you look at a big company that has a smaller child, that it could spin off, right? There's a couple things that you would want to look out for when you're seeing, so you'll probably have noticed, like when we talked about Southwest Airlines as an airline gets kind of pegged into the same, roughly the same price to earnings ratio as other airlines do. So people typically value businesses in the same industry with the same kind of multiples. Tech companies get higher price to earnings multiples. Airlines get very low multiples. Car companies, low multiples. So if you imagine a company, let's go back to our Sears and example. Sears and Allstate are two different businesses, right? One of them is a retail, company, and this is the 70s, so longer time ago. And Allstate is an insurance company that was at the time, I think, was, everything that they're doing now. Those are completely different industries, right? They have very different operating characteristics, very different metrics. So if you have this small company called, like Allstate inside a much, much larger organization, most analysts, most institutional investors, most retail investors aren't paying attention to the Allstate business. They're paying attention to the Sears business. And if Sears is doing well and Allstate is struggling, or vice versa, you may not necessarily see it because Sears is gobbling up, it's sucking up all the attention, right? And so what happens is people tend to value those businesses based on what Sears is doing, not what not what the parent company is doing, not what the child company is doing. And that kind of keeps things awkward for a lot of analysts, because they're not they try to analyze the parent company because that's what's driving the underlying returns, and it's very hard for them to see what's happening with the child. And so that can give you a kind of a strange structure to the business, where it's not easy to see the returns that you could get if you separated the two businesses out. One may be growing at a much faster rate than another, which would also be a reason. One may be in an industry that's doing very poorly at the moment, and another may be doing very well. So you don't want to kind of tie the baggage together in those cases. But there's a couple other things that you may want to look at with spinoffs. So when you have a parent company, if it is of a certain size, it will be tied to an index. So that could be the S&P 500. In some cases, that's the Dow. If it's really, really big company. But the child doesn't meet the qualifications of being in the S&P 500. So spinning it off ends up putting this smaller asset into the institutional investors' hands, and they are not legal. Their charter for their index fund doesn't allow them to hold these spinoffs, so they have to immediately sell them. So you will see this actually in the first few weeks. The spinoff will occur. The institutionals are required to sell it as part of their their operating pro forma. They will dump the shares on the market, and now there isn't any buyers because at the time the spinoff has not actually shown up on anybody's radar. So go ahead, Becco.
Yeah, I think so. That's a really good point, right? So what we're going to mention from I think we have a few points that we want to mention about price, right? When the spinoff actually does spin off and exist as a separate entity, there is an incredible amount of downward pressure on this price. So, let's go back to our value investing fundamentals 101. As value investors, we want to buy great companies at really super incredible discount, right? So if you want to buy great companies at a super discount, we have to find these opportunities when there is incredible downward pressure on the price of the company. And the spinoffs is interesting because there's many elements at play that is exerting incredible amount of downward pressure on the price of the spinoff company. And one of the things that Hari mentioned here is that when the child company gets spun off and exists as its own independent company, it is no longer part of the bigger parent company. And the parent company might have been part of Dow Jones Industrial Average, the index, or S&P 500 index, whereas the small child company is no longer part of that index. And so all these institutional investors buying indiscriminately just S&P 500 index companies, they now have to sell the child company. So there's indiscriminate selling that happens when the child company is born. It exists as a separate entity. I'm not sure if that clarified anything there, but I just wanted to point out that we're going to list a few things. So one is the nature of being part of an index and not being a part of an index. That's one thing that we want to mention. There are a few other things that we want to mention. And all this is exerting an incredible amount of downward pressure on the price of the spinoff.
Yeah. So the other part of that is you have institutional holdings like actively managed funds, and they focus on certain industries. Like in the case of Sears, if it was a retail mutual fund, they wouldn't be allowed to own an insurance business. So they'll get this spinoff. They have to say, I can't, it's not part of my charter. I will sell it off. So it's not just the index funds, but that is a big driver of this, is that as the S&P 500 has, funds get these shares, they'll sell them. This is actually true for retail investors too. They bought the company because they saw value in the parent. The child is not why they're there, and then the child gets spun off.
Let's maybe I think this is a good time to just clarify that So let's say you guys own Sears, and the Sears is spinning off Allstate. Allstate becomes a separate entity, and you, as a holder, as an owner of Sears, all of a sudden, one day, when you open up your brokerage account, there's two different companies. There is Sears and there's Allstate, right? So you're getting this Allstate. The Allstate spun off from Sears. You still own Allstate because you owned Sears, right? So you're getting this company on your brokerage account that you have no idea about, and you're selling it because you don't know what that is, or you don't want to own insurance companies.
Yeah, so, and by the way, the parent company will still own shares in the child. So what they will do is they will keep the shares, some percentage of it, 20%, 30%, and they will file that as part of their filing with the SEC, so that they still participate in any upside that the child company has. So it's not a complete clean separation of the two companies. They'll own some percentage of it, and then they may sell it in a 3-year period or something like that. So, yeah. But the initial downward pressure for the price is usually related to things that have nothing to do with the value of the company. And so that, I think, is a very important part of, looking at these things, is that, the spinoff may be there to unlock value as all spinoffs, will propose. That's why they're doing it. But then there's more detailed, thing here that is kind of a quirk of the system, is that they force the sell off of these shares, and now you have an potentially undervalued asset that is to look at. So that's kind of why these spinoffs are really interesting, is that by unlocking value, you've also forced the price to go down because of shareholder interest. So
yeah. So we mentioned there are many kind of pressure, many elements that at play that exerts this downward pressure. We talked about not being no longer part of being an index, or too small for investors, or people just don't care to own something that they have no idea about. So those are some of the elements that we talked about. There are other things at play here, Hari. Would you like to elaborate on some of those things?
Yeah. So part of this is, we'll actually be talking about a checklist for spinoffs in the next episode, so that you can kind of, like we do with our investment list checklist that you guys can get from us by emailing us at info@valueinvestor.org or tweeting us at valueinvestortv. We'll be making a spinoff checklist for spinoffs that you can use to kind of evaluate how good a spinoff is. But one of the other areas that by splitting the company, this was an example that was actually in Joel Greenblatt's book, and actually occurred. A very similar situation occurred about a year ago now.
Yeah, about half. Yeah, about a year ago. Yep.
Was this company called Corepoint Logistics? So, or Corepoint Lodging. So Corepoint Lodging is it was actually taking all of the physical assets of LaQuinta hotels. So LaQuinta hotel chain is made up of two components, right? There's a management company that was managing the business, and then there was the physical hotel assets that are part of the it's the actual building and the property, plant, and equipment, so to speak. So a lot of these companies were splitting the companies into two. One would be managing the real estate, and so they would just collect a fee from the hotel. So the rules are, if you want to be a real estate investment trust, you have to pay out 90% of your income as dividends, and then you don't have to pay any taxes because your owners will pay the taxes on the dividends. And so what companies were doing was they were splitting up their management into a separate company that would just manage the hotel assets, and then the actual company was essentially just a company that existed holding assets for the hotels and so forth. So Corepoint split up, it gained all of the assets, and then LaQuinta's management company was bought by Wyndham. as part of the spinoff process. So Corepoint has been trading for about a year, and I think when it started, it was between like $25 and $28 a share, and has been pushed down to around $12 a share. And what they've been doing in this year or so interval is that they've been trying to remodel all of the LaQuinta stores so that they can charge hotels, so they can charge a higher price. So they've also had a lot of their hotels in areas that were shut down due to hurricanes in Florida and Houston. And so these assets will come back online, and they also converted into the tax entity, the real estate investment trust. So kind of a lot of things went on as part of this spinoff, but they're unlocking value. And right now, I think they're trading at like 50% of their book value or less. So there's a potentially undervalued business there, due to this spinoff, and a lot of indiscriminate selling that pushed the price down from $25 to $12 a share.
Yeah. LaQuinta is a really good example, and like Joel Greenblatt talks about in his book, Marriott did the same thing. LaQuinta is another example. So we'll talk about more of these down the road in our second episode when we go through checklists. But I just want to point out at the high level, spinoffs we kind of define what spinoffs are. It's pretty complex subject. So I just want to lay out kind of the high level bullet points. Spinoffs are where a child company gets spun off into its own entity. That's what spinoff is. Spinoffs are interesting because historically it has returned great returns. It has presented great returns for big heavyweight investors like Joel Greenblatt, or even just studying S&P 500 index versus a collection of spinoffs. We can see that spinoffs have done well. So that's why we need to really focus on this. And thirdly, if we look at why it is such a good investment opportunity, why it's such a fertile ground to look for different opportunities, is that there is a incredible downward pressure in price when it first becomes its own existing entity. So, and there are many reasons why there's incredible downward pressure on the price. One of them being it's not part of the index. Another is it's too small for institutional investors. And there are a few more things that we'll talk about down the road. But ultimately, kind of to summarize that point, there's downward pressure, and there can be some value to be had at this stage for spinoffs. Anything you want to add here? I think we could summarize here to this point for this episode, and then we can move on to the next to talk more in detail about kind of the checklist and why it's so important for us to look at these things.
I think you actually gave a pretty good summary already there. As far as what a spinoff is, and what are some of the reasons that they would be cheap, right?
Mm-hmm.
And we would still have to apply all of the same kind of thinking to our spinoff, thought process, right? Is as to what to look for, for kind of these businesses. But I think the best way for us to do that is, we want to go through it systematically, and that's why a checklist is very useful.
Mm-hmm. All right. I know this is a pretty complex subject. I would say this is more advanced topic in value investing. Would you say, Hari?
Yeah. I don't think anything that we've taught you is you would throw out. This is still very much, trying to buy $1 for 50 cents. You have to do a lot more analysis here, and you have to be, I think, be more careful about, these kind of investments, because, I think anybody who's listened to us up until this point has probably gotten enough knowledge. But I think it gets down to how long have you been buying stocks and analyzing companies. So none of the terminology will confuse you, but there's a little bit more going on here than just meets the eye, right? So
yeah, exactly. So if you don't fully understand this, that's okay. It took me quite a bit of time to really digest all of this material myself. So Don't worry if you don't feel like you have a full grasp on this. We'll talk about concrete examples as we go down the checklist. So that might help as well. So stay tuned, and we'll see you on the next one. Thanks, guys.
Thanks.